Before we begin, please remember that this presentation is for informational and educational purposes only. The content is not intended to be a substitute for professional financial or career advice. Always seek the guidance of a qualified professional with any questions you may have regarding your personal financial situation or career path. What if I told you there's a career in the United States where the average income is over $100,000 a year, and you don't need a 4-year college degree to get started? A career where you spend your days helping people achieve the single biggest dream of their lives. You're not just sitting in a cubicle pushing papers. You are literally handing families the keys to their future. This isn't some far-fetched fantasy. This is the daily reality for a mortgage loan originator. But let's be honest. The term mortgage loan originator sounds corporate. Sounds boring. It sounds like someone in a back office stamping documents. And that is the biggest misconception that is costing people a shot at an incredible life-changing career. If you're feeling stuck in a job that has a low ceiling, if you're tired of your income being dictated by someone else, or if you crave work that has a real tangible impact on people's lives, then you need to listen very closely. Because over the next 10 parts, I'm going to pull back the curtain on one of the most misunderstood and lucrative professions in the financial world. This isn't just a video explaining a job title. This is your roadmap. We will cover exactly what a loan originator does day to day, the surprising ways they make their money, the step-by-step process to get licensed, and the unvarnished truth about the challenges and the massive rewards of this career. By the end of this series, you will know with absolute certainty if this is the right path for you. So, what does a mortgage loan originator or MLO actually do? Forget the image of a stuffy banker. Think of yourself as a financial quarterback for the biggest purchase someone will ever make. When a person decides to buy a home, they don't just walk into a bank and ask for $300,000. They are stepping into a complex, intimidating world of interest rates, credit scores, debt-to-income ratios, and a dozen different types of loans. They're scared of making a mistake that could cost them thousands of dollars and haunt them for 30 years. Your job is to be their guide, their strategist, and their champion through that entire maze. You are the first person they talk to, and you are the central point of contact who coordinates with the real estate agent, the underwriter, the appraiser, and the title company to get the deal to the finish line. You're part financial advisor, part project manager, part therapist, and part detective. You don't just sell a loan. You craft a financial strategy. You're the one who looks at a family's entire financial picture, their income, their savings, their debts, their dreams for the future, and helps them choose the one single mortgage product out of hundreds of possibilities that will set them up for success. The weight of that responsibility is huge, but the satisfaction you get from seeing a family get their keys at the closing table, it's a feeling that very few careers can offer. To really understand the role, let's break it down into 3 core functions. Every successful MLO masters these 3 pillars: the hunt, the consultation, and the finish line. First, let's talk about the hunt. This is the part that scares a lot of people, but it's also where the freedom and unlimited income potential comes from. A loan originator is an entrepreneur. You don't sit around waiting for the phone to ring. You have to go out and find your clients. This is the business development side of the job. So how do you do it? Your primary source of business will be relationships. You become the go-to mortgage expert for a network of real estate agents. Think about it. Every time a realtor has a client who needs to buy a house, who do they need? A great loan originator. You build trust with these agents by being reliable, knowledgeable, and incredibly good at closing loans on time. You take them to coffee, you host educational events, you become their partner in business. When an agent knows you can get their client's deal done smoothly, they will send you business over and over again. But it doesn't stop there. You're also networking with financial planners, who have clients looking to leverage their assets to buy property. You're building relationships with home builders, whose customers need financing for new construction. You are the hub of the home buying universe in your local community. And in the modern world, the hunt has gone digital. It's about building a personal brand. It's creating helpful content on social media that answers the questions first-time homebuyers are too afraid to ask. It's making short videos explaining the difference between an FHA and a conventional loan. It's positioning yourself not as a salesperson, but as a trusted advisor, so that when someone in your town thinks mortgage, they think of your name first. This is not a 9-to-5 clock-in, clock-out job. You are building your own business under the umbrella of a larger company, and your effort directly translates to your income. Once you've mastered the hunt, you move to the second pillar, the consultation. This is the heart of the job. A potential client, maybe referred by a realtor, calls you. They're excited, they're nervous, and they have a million questions. This is where you shine. Your first conversation is a deep dive. You become a financial detective. You're not just asking, "How much money do you make?" You're asking about their life. "Tell me about your job security. Are you planning on having kids in the next few years? What's your long-term goal with this house? Is it a starter home or your forever home?" You'll guide them through collecting their financial documents, pay stubs, W-2s, bank statements, tax returns. It feels invasive to them, so you have to be empathetic and explain why you need each piece of information. Then you analyze everything. You're looking at their credit report, calculating their debt-to-income ratio, verifying their assets for a down payment. You're putting together the pieces of a complex financial puzzle. Based on that puzzle, you strategize. Maybe their credit score is a little low for a conventional loan, but they qualify perfectly for an FHA loan with a lower down payment. Maybe they're a veteran, and a VA loan with zero down payment is their golden ticket. Your job is to present them with clear, understandable options. You break down the numbers, explain the pros and cons of each choice, and empower them to make the best decision for their family. This consultation phase is where you build unshakable trust. You're not selling them a rate. You're providing them with a plan for their future. And it's this process of taking someone from a state of confusion and anxiety to a state of clarity and confidence that is incredibly rewarding. This is where you stop being a loan officer and become their most trusted financial guide. So what does being a trusted financial guide actually look like day to day? It's not about shuffling papers and punching numbers into a calculator. It's about wearing three very different, very important hats and mastering the art of switching between them in a heartbeat. The first hat you'll wear is that of the detective. Every new client is a mystery. They come to you with a dream, a house with a yard, a condo downtown, a place to raise their family. But they also come with a history, a financial history, written in the language of pay stubs, tax returns, and bank statements. Your job as the detective is to piece it all together. You're not just collecting documents. You're looking for clues. You're asking the questions no one else has. "I see you had a gap in employment 2 years ago. Can you tell me what was happening then? This large deposit in your checking account, where did that come from?" This isn't about being nosy. It's about building a case. A rock-solid case for why this person, this family, is a good and worthy risk for a lender to take. You have to understand their story. Was that employment gap because they were courageously starting their own business? Was that large deposit a gift from a loving parent, meant to help with the down payment? Each detail matters. You become a financial archaeologist, digging through the layers of their life to uncover the full picture. You'll find things they forgot about, like an old medical collection account. You'll uncover strengths they didn't even know were strengths, like a long history of consistent rent payments. You have to be curious. You have to be meticulous, because if you miss a single clue, the entire case can fall apart later, causing heartbreak and disaster for your client. This detective phase is the foundation of everything. Get it right and you're on the path to success. Get it wrong and you're setting everyone up for failure. Once you've gathered all the evidence, you take off the detective's hat and you put on the hat of the strategist. This is where the real magic happens. You've got the client's story, their income, their assets, their credit profile. Now you have to look at the vast, complex world of mortgage products and find the perfect weapon for the battle ahead. Is this a first-time homebuyer with a lower credit score and minimal savings? Maybe an FHA loan is the answer, with its flexible guidelines and low down payment. Is this a veteran who has served our country? Then you absolutely must explore their VA loan benefit, a powerful tool that can get them into a home with zero down payment. Is this a high-income earner with perfect credit buying a home in a rural area? A conventional loan might be good, but a USDA loan could be even better, potentially offering 100% financing. Being a strategist isn't about just picking the first loan that fits. It's about playing chess, not checkers. You're thinking 3 moves ahead. You're considering not just how to get the loan approved today, but which loan will set your client up for the most financial success tomorrow. You might run the numbers and show them that by paying a little more now to buy down their interest rate, they'll save tens of thousands of dollars over the life of the loan. You might advise them to wait 3 months, pay down a specific credit card, and then reapply to qualify for a much better rate that will lower their monthly payment for the next 30 years. This is where your expertise provides immense value. Anyone can plug numbers into a system. A great MLO, a true strategist, understands the nuances of every loan program, and uses that knowledge to craft a custom-tailored solution that fits the client's life like a glove. You are their financial architect, designing the blueprint for the single largest investment they will ever make. But even the best detective and the sharpest strategist will fail if they can't master the third hat, the coach. The home buying process is an emotional roller coaster. It is one of the most stressful experiences a person can go through. Your clients will be filled with excitement one day and crippling anxiety the next. They'll get their offer accepted and feel like they're on top of the world. Then the underwriter will ask for one more document, and they'll feel like the whole deal is about to collapse. Your job as the coach is to be their steady hand, their unwavering voice of reason and encouragement. You are the one who calls them before they can call you with a panicked question. You're the one who explains complex underwriting conditions in simple human terms. You're the one who sets clear expectations from the very beginning, telling them, "Look, this is going to be a tough process. There will be bumps in the road, but I am here with you every step of the way. And together, we are going to get to the finish line." When the appraisal comes in lower than the purchase price, you're not the one who delivers bad news. You're the one who calls with a plan. "Okay, this happened. It's not ideal, but it's not the end. Here are our 3 options." You have to absorb their stress without taking it on yourself. You have to project confidence even when things are uncertain. You're their advocate, their cheerleader, and sometimes their therapist. You celebrate the small victories with them, like getting appraisal back or clearing a tough condition. And you prepare them for the hurdles. This human element is what separates a transactional loan officer from a relational, trusted advisor. The technology can do the math. The software can generate the paperwork. But no algorithm can calm a nervous first-time homebuyer's fears at 9 p.m. on a Tuesday night. That's all you. That's the irreplaceable value you bring. So a day in the life isn't just one thing. You start your morning as a detective, on the phone with a new couple, patiently asking questions to understand their unique financial puzzle. By mid-morning, you're a strategist deep in thought, comparing loan scenarios for a self-employed business owner, trying to find the perfect angle to get their complex income approved. After lunch, you're a coach talking a client off a ledge because the seller is being slow to respond to a repair request. Then you're back to being a detective, combing through a bank statement to source a large deposit for the underwriter. It's a constant, fluid dance between analysis and empathy, between numbers and people. The core skills required aren't what you think. Yes, you need to be good with numbers and understand guidelines, but that's the baseline. The real skills are grit, the ability to solve complex problems under pressure. It's impeccable communication, the ability to make the complicated simple. And most of all, it's a deep, genuine sense of empathy. You have to actually care. You have to feel the weight of their dreams on your shoulders and be driven by a relentless desire to see them succeed. You're a puzzle solver, a strategist, a communicator, a negotiator, and a guide, all wrapped into one. So you're part detective, part strategist, and part coach. You understand the what and the why. But how do you actually earn the right to play this game? How do you get the license, the training, the badge that allows you to guide people through this monumental journey? That involves a whole other set of challenges and requirements, starting with a single crucial test that stands between you and this career. The test is called the SAFE MLO test. SAFE stands for the Secure and Fair Enforcement for Mortgage Licensing Act. And that name tells you everything you need to know about why this entire process exists. It wasn't born in a boardroom to create bureaucracy. It was forged in the fire of the 2008 financial crisis. Before 2008, in many states, you needed more training to become a barber than you did to arrange a $500,000 mortgage for a family. The system was the Wild West, filled with people who didn't understand the complex financial products they were selling. And in some tragic cases, people who understood them all too well and used them to prey on unsuspecting borrowers. When the house of cards came tumbling down, the government stepped in and said, "Never again." The SAFE Act was the result. Its entire purpose is to create a new standard of professionalism, ethics, and competency in the mortgage industry. It's designed to protect consumers by ensuring that the person sitting across the table from them, guiding them through the biggest financial decision of their lives, is educated, vetted, and held accountable. So when you're studying for this test, remember, you're not just memorizing rules. You're learning the very framework designed to prevent a global economic meltdown from ever happening again. Your license isn't just a piece of paper. It's a pledge to uphold that standard. Your journey to that license begins with one small but critical step: getting your NMLS number. Think of the NMLS the nationwide multi-state licensing system and registry, as the central nervous system for the entire mortgage industry. And your NMLS number is like your social security number within that system. It is your unique identifier. It will follow you for your entire career. No matter which company you work for or which states you're licensed in. Every loan you do, every continuing education class you take, every consumer complaint filed, it's all tied to that number. It creates a permanent, public record of your career, ensuring transparency and accountability. Getting it is simple. You go to the NMLS website, create a profile, and they issue you a number. This is step 0. You can't even sign up for your required education without it. And that education is the next major milestone. Before you're even allowed to sit for the big test, you have to complete a minimum of 20 hours of NMLS-approved pre-licensing education. This isn't like a high school class you can sleep through. This is the foundational knowledge for your entire career. The curriculum is federally mandated and broken down into specific subjects. You'll spend 3 hours on federal laws and regulations, learning the alphabet soup of agencies and acts like TILA, RESPA, and ECOA. These are the rules of the road that dictate everything from how you can advertise to what you can and can't ask a borrower. Then you'll spend another 3 hours on ethics. And this is arguably the most important part of your training. This section dives deep into fraudulent practices, consumer protection, and the fiduciary duty you have to your clients. It directly addresses the kind of behavior that led to the 2008 crash. Things like steering borrowers into loans they couldn't afford just to get a higher commission, or falsifying documents to push a deal through. This is where the industry's soul-searching is codified into your training. Next, you get 2 hours on non-traditional mortgage products. Think interest-only loans, adjustable-rate mortgages with balloon payments, the exact kinds of complex and sometimes risky loans that were at the heart of the crisis. The goal here isn't to teach you how to sell them, but to teach you how to understand them, explain their risks, and ensure they are only used when it's genuinely in the borrower's best interest. The remaining 12 hours are electives, covering the broad strokes of general mortgage knowledge, from understanding loan calculations and underwriting basics to the finer points of the loan origination process. You'll do this course through an NMLS-approved provider, either online at your own pace or in a classroom setting. My advice? Don't just try to get it over with. Absorb it. This is the playbook. Once your 20-hour course is complete, you've unlocked the boss battle. The safe MLO test itself. This is the gatekeeper. You'll go to a designated testing center, sit at a computer, and face a 125-question multiple-choice exam. Now, here's a little inside baseball. Only 115 of those questions are scored. The other 10 are experimental questions they're testing for future exams, but you won't know which is which, so you have to treat every single one like it counts. You have 190 minutes to complete it, and you need a score of 75% or higher to pass. The test is a comprehensive review of your 20-hour course, broken down into 5 main categories: federal mortgage-related laws, which is the biggest chunk, general mortgage knowledge, MLO activities, which covers the day-to-day practical application of the rules, ethics, and a section called Uniform State Content, which creates a baseline of state-level regulation knowledge. Passing this test is a significant hurdle. The national pass rate hovers around 55 to 60%, which means nearly half of the people who take it fail on their first try. So how do you make sure you're in the passing half? You don't do it by memorizing questions. You do it by understanding concepts. The questions are designed to be tricky. They'll give you a scenario and ask you to apply the law, not just recite it. The best way to prepare is to invest in a good test prep program. These programs provide practice exams that mimic the style and difficulty of the real thing. Take as many as you can. Every time you get a question wrong, don't just look at the right answer. Dig in and understand why you got it wrong. Was it a law you misunderstood? A calculation you messed up? That process of diagnosing your weaknesses is what turns a failing score into a passing one. But passing that national test, as monumental as it feels, is not the finish line. It's more like winning the national championship. Now you have to win your home state's championship. Because the SAFE Act created a floor, not a ceiling. It's the minimum standard everyone in the country has to meet. But each state has the right to add its own licensing requirements on top of that. Some states might require additional hours of state-specific education. Some might have a second state-specific test you need to pass. Some have different application fees or net worth requirements. A loan originator in California has a different set of hoops to jump through than one in Texas or Florida. So a critical part of this journey is researching the specific requirements for the state, or states, you plan to operate in. The NMLS website has a comprehensive breakdown for each state, and you need to treat that as your personalized roadmap. Once you've passed your tests and completed your education, you formally apply for your license through the NMLS. And this is where they put your life under a microscope. You will be subject to a thorough background check, which has two primary components: a criminal history check through the FBI, and a credit report review. Let's talk about the criminal check first. The SAFE Act is crystal clear on this. You cannot obtain an MLO license if you have ever been convicted of a felony involving fraud, dishonesty, a breach of trust, or money laundering. There is no statute of limitations on this. A conviction from 20 years ago will block you. Additionally, you can't have had any felony conviction in the last 7 years. They are serious about keeping bad actors out of the industry. Then comes the credit report. This is the part that makes most people nervous. They think, I have some student loan debt. I was late on a credit card bill 2 years ago. Am I disqualified? The answer is almost certainly no. Regulators are not looking for a perfect 850 credit score. They are looking for a demonstrated pattern of financial irresponsibility. What does that mean? It means they're looking for major red flags that suggest you can't manage your own financial affairs, which would be a pretty bad sign for someone who is supposed to manage other people's. Things like outstanding tax liens, recent foreclosures, multiple accounts in collection, or a pattern of defaulting on your debts. Those are the things that will raise questions and could lead to a denial. A low score because of high utilization or a few past mistakes is usually not a deal breaker, as long as you can show you're handling your obligations now. The logic is simple. If you can't be trusted with your own finances, how can you be trusted with a borrower's? So you've gotten your NMLS number, you've completed your 20 hours, you've passed the national test and any state tests, and you've cleared the background and credit checks. You must be ready to start originating loans, right? Not quite. There is one final critical piece of the puzzle. You can't just be a licensed individual. Your license has to be active under a sponsoring company. You can't be a lone wolf. You have to be hired by a licensed mortgage brokerage, a direct lender, or a bank. They are the ones who will officially sponsor your license, making it active and allowing you to legally operate under their umbrella. It's their oversight, their compliance department, and their reputation on the line with every loan you do. This means your next great challenge isn't another test or another form to fill out. It's getting a job. It's finding the right company that will not only activate your hard-earned license, but will also give you the training, support, and leads you need to actually build a career and succeed. And that is a whole other ball game. So let's talk about that ball game. Because this next choice, the decision of where you hang your license for the first time, is arguably the most important decision you will make in your entire mortgage career. It is more important than your NMLS test score. It is more important than the college you went to. It is the single biggest factor that will determine whether you are still in this business in 2 years, or whether you become another statistic, one of the 80% of new loan officers who wash out in that time frame. You see, not all mortgage companies are created equal. In fact, they operate in fundamentally different universes. And if you don't understand the landscape, you're flying blind. You might end up in a place that is a terrible fit for your personality, your financial situation, and your goals. Broadly speaking, there are two major paths you can take when you start out. You can go work in the retail channel, or you can join a mortgage brokerage. Let's start with retail. This is the world most people are familiar with. Think big banks, your Wells Fargos, your Chases, your Bank of Americas. It also includes large, national direct lenders, companies like Rocket Mortgage or Loan Depot. The key defining feature of a retail lender is that they lend their own money and you, as the loan officer, work directly for them. You are an employee. Think of it like working at a big box store like a Best Buy. When you walk into Best Buy, the employees can only sell you the TVs that Best Buy has decided to stock. They can't run down the street to a competitor to grab a different model for you. They work for the brand, they sell the brand's approved products, and they operate within the brand's ecosystem. This retail model has some massive advantages, especially for someone brand new. The number one advantage? Leads. Many large retail lenders, especially the call center-based ones, will literally hand you the phone and feed you live customers who have already expressed interest. For a new MLO terrified of the question, where will I get business? This feels like a godsend. You have people to talk to from day one. If you're at a bank with physical branches, you might get referrals from the bank tellers and personal bankers. This is a huge weight off your shoulders. The second big advantage is training and support. These massive companies have structured, well-funded training programs. They have entire departments for marketing, for processing, for underwriting, for compliance. There is a system, a process, a safety net. You are a W-2 employee, which means you get a steady paycheck during training, and often a base salary or a draw against future commissions once you start producing. You get health insurance, a 401k, paid time off. Feels safe. Feels stable. But there's a trade-off. A big one. Remember that Best Buy analogy? You can only sell the products on your shelf. In the mortgage world, this means you can only offer your bank specific loan programs with their specific interest rates and their specific underwriting guidelines. And every bank has what we call overlays. These are extra rules and restrictions they place on top of the baseline government guidelines for loans. Maybe your bank has an overlay that says they won't lend to anyone with a credit score below 640, even though the official FHA guideline is 580. Maybe they have a weird rule about self-employed income. So what happens when you get a wonderful family, pre-approved, ready to buy their dream home? But the husband's credit score is 638. Your bank says no. End of story. There's no other option. You can't take that loan down the street. You have to make the heartbreaking phone call and tell them the deal is dead. You lose the client, you lose the commission, and you damage your relationship with the real estate agent who referred them to you. This happens every single day in the retail world. You are a cog in a very large, very rigid machine. The other major drawback is compensation. In exchange for the leads, the salary, and the support, you receive a much smaller commission split. You're paid far less per loan than your counterparts in the broker world. Now let's look at the other side of the coin. The mortgage broker. If the retail lender is a big box Best Buy, the mortgage broker is an independent personal shopper. A broker doesn't work for one single lender. Instead, a brokerage is an independent company that has relationships with dozens, sometimes hundreds, of different wholesale lenders. The broker's job isn't to sell one bank's product. Their job is to take the client's unique financial situation and shop it across their entire network of lenders to find the absolute best fit, the best rate, the best program, the best terms. The single greatest superpower of a mortgage broker is choice. Let's go back to that family with the 638 credit score. The retail bank said no. The broker says, hold on. Lender A won't do it, you're right. But I know Lender B specializes in this, and Lender C actually has a special program that fits you perfectly. The broker finds a home for the loan. They save the deal. They become a hero to that family and to the realtor. This ability to say yes when others say no is how independent brokers build legendary reputations and businesses that run entirely on referrals. Because you're shopping multiple lenders, you almost always have access to better pricing and a wider variety of niche products. You can help more people. The other huge advantage is compensation. As a broker, you're typically an independent contractor or 1099. The trade-off is that you get a much larger piece of the pie. Your commission on a single loan can be double, triple, or even more than what a retail loan officer would make on the exact same loan amount. The earning potential is significantly higher. You have more control, more flexibility, and you're essentially running your own business under the brokerage's umbrella. Sounds amazing, right? So what's the catch? It's the flip side of the retail world's biggest advantage. The catch is leads. In 99% of brokerages, you get 0 leads. None. You are 100% responsible for generating your own business. You have to wake up every single day and figure out how you're going to find someone who needs a mortgage. You are a hunter. You have to network with real estate agents, financial planners, and divorce attorneys. You have to build a social media presence. You have to call past clients. You have to build a business from scratch. This is why the failure rate can be so high in the broker world. People are seduced by the high commission splits, but they drastically underestimate the difficulty of sales and marketing. There's also typically less formal, structured training. It's more of an apprenticeship model where you learn from senior loan officers and the brokerage owner. And because you're an independent contractor, there's no salary, no benefits, no 401k. If you don't close a loan, you don't get paid. Period. You need to have a significant amount of savings, at least 6 months of living expenses, to survive while you build your pipeline. So we have 2 very different paths. The retail path offers stability, support, and leads, but at the cost of flexibility and income potential. The broker path offers freedom, massive income potential, and the power of choice, but at the cost of stability and the immense pressure of having to build your own business from the ground up. So which one is right for you? This is not a trick question. There is no better option. There is only the better option for you right now at this stage of your life. You have to be brutally honest with yourself. Are you a purebred entrepreneur who loves the thrill of the hunt and is willing to eat what you kill? Or are you more of an intrapreneur? Someone who wants to learn the ropes inside a structured system, with a safety net below you? Do you have a family to support and need the security of a W-2 and health insurance from day one? Or do you have the savings and the risk tolerance to go 6 months without a single paycheck? Are you a disciplined self-starter who can manage your own time and marketing efforts? Or do you thrive with the structure of a corporate environment where your tasks are laid out for you? Answering these questions honestly is the first step. Because choosing the right environment isn't just about getting a job. It's about putting yourself in a position to actually survive and thrive in this industry. Once you've decided on the type of company that fits your personality and financial reality, the next step is to find a specific one. And that involves the interview process, a process where you should be interviewing them just as much as they are interviewing you. You need to know the right questions to ask, the hidden red flags to look for, and the one critical piece of information that will tell you everything about your chances of success at that company. And that's precisely what we're digging into in the next part. Alright, let's flip the script. Most people walk into a job interview hoping to be chosen. They're nervous, they're on the defensive, and they're trying to prove their worth. That is the single biggest mistake you can make when interviewing for a mortgage loan originator position. You are not there to be chosen. You are there to choose. This is an interview, yes, but you are interviewing them just as much, if not more, than they are interviewing you. Why? Because where you hang your license for your first 1 to 2 years will have a monumental impact on whether you succeed or crash and burn. You are the asset. Your future pipeline is the prize. And you need to decide if this company is worthy of it. So you walk in, you sit down, and after the initial pleasantries, they're going to ask you questions. But your mind should be on the questions you need to ask. Let's break down your interrogation into 3 critical categories: the support system, the money machine, and the operational engine. First, the support system. This is about survival. Your first few months will be a whirlwind of confusion, panic, and mistakes. It's inevitable. The question is, who's there to catch you when you fall? Don't ask, do you have good support? Of course they'll say yes. That's a useless question. You need to get specific, tactical, and a little bit pointed. Start with this. Could you walk me through what happens on a Tuesday morning when I have a file that's blowing up? The appraisal came in low, the client is panicking, and the real estate agent is screaming at me. Who is my first call? Is that person a dedicated manager, a floating team lead, or a help desk? What's their average response time? And crucially, does that person have the authority to actually fix problems, or are they just a messenger? You see the difference? You're not asking about a vague concept. You're testing their process with a real-world disaster scenario. A great answer sounds like, your first call is to Sarah, your dedicated team lead. She only manages 5 other new LOs, so she'll pick up immediately. She's a former top producer and underwriter, and she has the authority to directly communicate with the appraisal management company and the underwriting team to find a solution. A red flag answer sounds like, well, you'd submit a ticket to the support portal, and someone from the operations team should get back to you within 24 hours. 24 hours? In mortgage time, that's an eternity. The deal is dead. Next, you ask about the processor. The processor is your lifeline. They're the person who takes your beautifully crafted loan application and shepherds it through the labyrinth of underwriting. So you ask, what is the average ratio of loan originators to processors at this branch? If the answer is 5 to 1, that's fantastic. That processor has time to dedicate to your files. If the answer is 15 to 1, or they get cagey and say, it varies, that's a massive red flag. It means their processors are completely overwhelmed, your files will get sloppy service, and you will spend half your time doing the processor's job instead of originating new loans. Now let's talk about the money machine. This is all about how you get paid and, more importantly, how you get clients. The number one reason new MLOs fail is an empty pipeline. They don't know how to generate leads. So, you need to dissect their lead generation model with the precision of a surgeon. Again, don't ask a lazy question like, do you provide leads? They'll all say yes. You need to know the quality and the cost. Ask this. When you say you provide leads, could you describe the source? Are these live transfer inbound calls from people who just filled out a form? Are they aged internet leads from 6 months ago? Or are they refinances from the company's past client database? The difference in quality there is the difference between a six-figure income and going broke. Then you follow up with the kill shot. What is the average conversion rate from lead to closed loan for the leads you provide to new originators? A strong, transparent company will know this number. They'll say something like, "Our live transfers convert at about 10% for our top guys, but we expect new LOs to be in the 3 to 5% range for the first 6 months." That's a real answer. It's honest and it sets expectations. A weak company will say, "Oh, it really depends on the loan officer's skill." That's a dodge. It means their leads are probably garbage, and they're putting all the blame on you when they don't convert. And don't forget to ask about the cost. Is there a cost for these leads, and if so, how does it affect my commission split on those deals? Some companies give you free leads but take a massive chunk of the commission, sometimes 50% or more. Other companies make you pay for leads up front. You need to know the exact math before you sign anything. Finally, let's get to the operational engine. This is the part everyone misses, but it is the single most important factor in determining your success and sanity. It's about the company's ability to actually do its job. Close loans efficiently. This is where you find that one critical piece of information we talked about. You've asked about support. You've asked about leads. Now you look the hiring manager directly in the eye and you ask the question that tells you everything you need to know about the health of their entire operation. It's not about the commission split. It's not about the free coffee. It's this. What are your current average turn times? From the day a loan is submitted to underwriting to the day it receives a clear to close. This one question is a master key. It unlocks everything. Let me explain why. A company's turn time is the ultimate measure of its efficiency. It tells you how good their technology is, how well staffed their operations team is, and how organized their entire process is. If they answer, "Right now we're running about 15 to 20 business days on purchases," that is a green light. That's a company that has its act together. It means their underwriters aren't overwhelmed. It means their systems are streamlined. It means when you promise a real estate agent and a homebuyer that you can close by the end of the month, you can actually deliver on that promise. And in this business, your reputation is everything. Fast, reliable closings are how you build a network of real estate agents who will send you business for years to come. But what if they hesitate? What if they say, "Well, with the market being so busy, we're probably looking at around 45, maybe 50 days right now." Run. Do not walk, run for the exit. A 45-day turn time is a sign of a company in chaos. It's a symptom of a deeper disease. It means they are understaffed, their technology is outdated, or their management is incompetent. It means your purchase contracts will expire. Your buyers will lose their dream homes. Your real estate agents will stop taking your calls. You will be spending all day, every day, putting out fires and apologizing for delays that are not your fault. You will be working twice as hard for half the results and you will burn out. That one number, the turn time, is more revealing than their commission plan, their marketing materials, or the fancy title they offer you. It is the real-world rubber-meets-the-road indicator of whether you are joining a high-performance race car or a broken-down jalopy. One will take you to the winner's circle. The other will leave you stranded on the side of the road, wondering why you ever got into this business in the first place. So ask the question, listen carefully to the answer, and choose the company that respects your time, your client's dreams, and your future career. Now, walking through the doors on your first day, that feeling of choosing the right company is your foundation. Because what happens next is designed to test that foundation to its absolute limits. They call it drinking from a fire hose, and it's the most accurate cliche you'll ever live through. Your first 90 days as a mortgage loan originator aren't about becoming a top producer. They're about survival. They're about building the habits and the mental fortitude that will prevent you from becoming one of the 80% who wash out in the first 2 years. Forget everything you think you know about a typical office job. There's no gentle onboarding process where you spend a week setting up your email signature and learning everyone's name. No, you'll be handed a stack of underwriting guidelines thicker than a phone book, given a login to a customer relationship management system that looks like the cockpit of a 747, and told about compliance rules so arcane and specific that they make the tax code look like a children's book. FHA, conventional, VA, USDA, jumbo, non-QM. It's an alphabet soup of loan programs, each with its own labyrinth of rules about debt-to-income ratios, credit scores, and property eligibility. Your brain will feel like a sponge that's been thrown into the ocean. You'll absorb so much information that you'll feel saturated, overwhelmed, and you'll go home every night with a low-grade headache, wondering if you'll ever be able to remember it all. And here's the brutal truth. You won't. Not at first. The goal isn't to memorize the entire library of lending. The goal is to learn how to find the answer. It's about knowing which guide to open, which underwriter to ask, which senior loan officer to shadow. The real skill you're developing in these early weeks isn't knowledge. It's resourcefulness. But the information overload isn't even the hardest part. The hardest part is the silence. It's the deafening quiet of an empty pipeline. It's sitting at your desk, armed with all this new, confusing knowledge, and having absolutely no one to use it on. This is the void. It's the existential crisis every new MLO faces. You have the title, you have the license, you have the desk, but you don't have any clients. And in a commission-only or commission-heavy role, no clients means no income. This is the moment the panic starts to creep in. The doubt. The little voice that whispers, "You've made a huge mistake." This is where the company you chose really matters. A bad company throws you into the void and says, "Good luck." A great company gives you a roadmap to cross it. And that roadmap is built on 3 pillars that should define every single day of your first 3 months. Learn, prospect, and execute. Let's break it down. Your day should be divided into thirds. The first third is dedicated to learning. You're a student of the game. You are shadowing the top producers in your office. You're not just watching them take applications. You're listening to how they talk to clients. How do they build rapport? How do they explain complex fee structures? How do they de-escalate a stressful situation when a borrower is freaking out? You should be begging to listen in on their calls. Take meticulous notes. After the call, ask them why they phrased a question a certain way. Why did they choose that specific loan program? This is your master's level education, and you're getting paid to get it. You're also reading those guidelines not just to pass a test but to find opportunities. You're learning the difference between a hard and fast rule and a guideline that has some flexibility. This is where you start to provide real value. The second third of your day is for prospecting. This is the most uncomfortable, most terrifying, and most critical part of your job. It means picking up the phone. It means calling real estate agents who already have a dozen MLOs vying for their attention. It means facing rejection not just once but over and over and over again. Your goal is not to get a loan application on your first call. Your goal is to start a conversation. Let me tell you about a brand new MLO I once mentored. Let's call him Alex. Alex was terrified of the phone. He'd spend hours organizing his desk, reading guidelines, doing anything to avoid making calls. Finally, I told him, "Your only goal today is to call one agent and ask them one question. What's the single biggest reason a lender has ever lost your business?" He was nervous, his voice cracked, but he made the call. The agent was taken aback. She was used to MLOs calling and bragging about their low rates and fast turn times. But Alex asked about her pain points. She spent 10 minutes ranting about a lender who couldn't close on time and cost her a commission. Alex just listened. He didn't sell. He didn't promise. He just said, "Thank you for sharing that. I really appreciate your perspective." A week later, that agent called him. Not with a perfect, easy loan. She called him with a problem file that her go-to lender couldn't figure out. She remembered the kid who listened. That one call, born out of terror, was the first seed of his entire career. Your prospecting time is about planting those seeds. It's about networking, going to open houses, and building a reputation as the person who listens more than they talk. The final third of your day is for executing. In the beginning, this part of your day might be small. It's working on the 1 or 2 loan files you actually have. But you treat those files like they're the most important transactions in the history of the world. You over-communicate with the client. You provide updates to the real estate agents before they even have to ask. You learn the loan processing software inside and out. You build a relationship with your processor and your underwriter. You become an expert on the process so that when the volume does come, you're not fumbling with the basics. You're a well-oiled machine. Learning, prospecting, executing. That's the cycle. Every single day. But underlying all of this is the most important transformation that has to occur. The mindset shift. You are no longer an employee. You are a business owner. Your name is your brand. Your reputation is your most valuable asset. The company you work for provides the tools, the support, and the platform, but you are the CEO of your own mortgage business. This means you have to kill the employee mindset. The employee waits to be told what to do. The business owner hunts for opportunities. The employee clocks out at 5. The business owner works until the job is done. The employee sees a problem and passes it to their manager. The business owner sees a problem and obsesses over it until they find a solution. This is why so many people fail. They want the upside of being a business owner, the freedom, the high income potential, without accepting the radical personal responsibility that comes with it. You will feel like an imposter. You will be on the phone with the client, talking about the single largest financial decision of their life, and that little voice will pop into your head. Who are you to be giving this advice? You were learning what a basis point was 3 weeks ago. Everyone feels this. Every single top producer you admire felt that exact same way. Confidence isn't something you start with. It's a byproduct of action. It's earned by making one more call, by learning one more guideline, by successfully navigating one more difficult conversation. You build it brick by brick, day by day, until one morning you wake up and realize the little voice of doubt has gotten a lot quieter. You follow this structure, learn, prospect, execute, and you embrace that business owner mindset. You survive the fire hose. You cross the void. You start to see a few seeds sprout. You get a referral, then another. You close your first loan, then your second. You start building momentum. You feel like you're finally getting it. You've put together a beautiful, clean, perfectly documented loan file for a wonderful family buying their dream home. You submit it to underwriting feeling proud. You've done everything right. But all the prospecting, all the learning, and all the execution in the world means nothing if you can't handle the one phone call that every MLO, new and old, absolutely dreads. The call where your underwriter gets on the line, and with a few simple words tells you that your perfect loan is about to die. This isn't just a phone call. It's a judgment. And the person on the other end of the line, the underwriter, is the judge, jury, and often the executioner of your loan file. So who is this mysterious, powerful figure? An underwriter is the final guardian of the lender's money. They are the person who actually makes the decision to approve or deny the loan. They don't know your borrower. They've never spoken to them. They don't care about their dreams of a white picket fence or a backyard for their new puppy. Their entire world, their entire job, is contained within the digital file you submitted. They are trained to see risk. They are experts in sniffing out inconsistencies, red flags, and anything that deviates from the thousands of pages of guidelines set by Fannie Mae, Freddie Mac, the FHA, or the bank itself. Think of them like the most intense TSA agent you've ever met. You're excited about your vacation, you've got your ticket, you're ready to go. But they don't care. They only care if your water bottle is more than 3.4 ounces. The underwriter is that person, but for multi-$100,000 transactions. When an underwriter first reviews your file, they rarely give you a final unconditional approval. That's a unicorn. Instead, you get what's called a conditional approval. This is a huge milestone, but it's also the start of the real battle. A conditional approval is the underwriter saying, "Okay, I've looked at everything and in theory this loan works. However, I need you to prove, clarify, and document these 10 other things before I'm willing to sign off and risk the bank's capital." These things are called conditions. And this is where a great MLO separates themselves from a mediocre one. A mediocre MLO sees a list of conditions, forwards it to the borrower with a note that says, "Please send these," and hopes for the best. A great MLO becomes a detective, a translator, and a therapist. Let's say a condition comes back. Source and document large deposit of $5,721 on page 3 of checking account statement. The borrower sees that and panics. What does that mean? Are they accusing me of something? It was a gift from my aunt for my wedding. A bad MLO just says, "Well, you need to prove it." A great MLO gets on the phone and says, "Okay, great news. The underwriter has reviewed our file, and we're on the path to approval. They just need a little more clarity on a few items. I see they're asking about that deposit from your Aunt Sally. No problem at all. Here's what we need. We're going to get a simple gift letter from her stating the money is a true gift with no expectation of repayment, and we'll need a copy of her bank statement showing the money leaving her account. This is just to prove to the lender that the money isn't a secret loan you have to pay back, which would affect your debt-to-income ratio. It's a standard request, and we'll knock it out together." See the difference? It's about managing the process, managing expectations, and managing the client's very real anxiety. The conditions can range from the painfully simple to the mind-bogglingly complex. It could be as easy as needing the most recent pay stub because a pay period just passed. Or it could be needing a full paper trail for cash that was sitting in a safe for 10 years before being deposited. It could be a letter of explanation for a single late payment on a credit card from 3 years ago. It might involve untangling a complex self-employed business structure. where you have to prove that the income is stable and likely to continue. You become a document bloodhound. You're working with the borrower, their HR department, their CPA, their divorce attorney, you name it. And you're not just collecting these documents. You're scrutinizing them before you send them back to the underwriter. Does this document actually satisfy the condition? Or does it just create more questions? Sending the wrong thing to an underwriter is like throwing gasoline on a fire. You'll just get more conditions, more questions, and a more frustrated client. This back and forth process is called clearing conditions. You submit the documents, the underwriter reviews them, and hopefully they sign off on them. But sometimes they don't. Sometimes the underwriter interprets a guideline in a way you completely disagree with. They might deny the loan based on a technicality that you believe is incorrect. This is where you have to put on your lawyer hat. This is the art of the rebuttal. You don't just call the underwriter and yell. That's the fastest way to get your loan permanently denied. Instead, you build a case. You go back into the 1,200-page FHA guideline manual. You find the specific section, the exact sentence, that supports your position. You write a professional, well-reasoned rebuttal, citing the evidence. You might say, per FHA Guideline 4000.1, Section 2, Part A, Chapter 4, Subsection C, Paragraph 2, income from this source can be considered with a 12-month history, not the 24-month history you've requested. I have attached the relevant documentation highlighting this history. Please reconsider. It's a high-stakes debate where you have to be smarter, more prepared, and more knowledgeable about the rules than the person whose entire job is to enforce them. Winning a rebuttal is one of the most satisfying feelings in this entire profession. You've not only saved your client's dream, but you've proven your expertise. This entire phase, from conditional approval to final approval, can take days or even weeks. It is the most stressful part of the process for everyone involved. Your borrower is on edge, packing their life into boxes, thinking the deal could fall apart at any second. Your real estate agent is calling you every day for an update. And you are in the middle, the calm center of the hurricane, projecting confidence and competence while furiously working behind the scenes to solve complex financial puzzles. And then, after all the stress, all the documents, all the late-night emails and rebuttals, it happens. An email hits your inbox. The subject line contains 3 of the most beautiful words in the English language. Clear to close. Clear to close. CTC. It means every condition has been met. Every box has been checked. The underwriter has given their final, unconditional blessing. The bank is officially committing the funds. The loan is approved. That feeling. It's a potent mix of relief, victory, and pure adrenaline. You've done it. You've navigated the labyrinth. You've slayed the underwriting dragon. You immediately call your borrower and the real estate agents to share the good news. And for a moment, you are an absolute hero. You've taken a dream sketched out on a napkin during an initial consultation and turned it into a tangible, approved, fundable reality. But the celebration is short-lived, because getting the clear to close is like winning the battle. You still have to win the war. The money isn't in anyone's hands yet. Now you have to get everyone to the closing table on time without any last-minute drama. And in the world of mortgages, the space between clear to close and the final signature is a minefield where one wrong step can still blow the whole thing up. Let's talk about that minefield. You've done everything right. The borrower's file is a work of art. The underwriter has given you the 3 most beautiful words in the English language. Clear to close. You've called the borrower, you've called the agents, everyone is celebrating. But you, the loan originator, you can't celebrate yet. Because you know what's coming. You know that the final 72 hours are a gauntlet of potential disasters. And you're the one who has to get everyone through it. The first landmine is the final walkthrough. This is where the buyer walks through the property one last time, usually the day of or the day before closing, to make sure the home is in the same condition they agreed to buy it in. What happens if the seller's movers knocked a massive hole in the drywall? What if the refrigerator that was supposed to stay is now gone? What if a pipe burst overnight and the basement is flooded? This isn't your fault, but it is now 100% your problem. The agents will be screaming at each other, the buyer is threatening to walk away. And you're getting frantic calls because if this closing doesn't happen today, the buyer's rate lock expires. You're not a contractor or a mediator, but suddenly you have to be both, working with the agents to negotiate a solution, maybe a credit from the seller or an escrow holdback that satisfies the buyer, the seller, and most importantly, the lender, who will not fund a loan on a damaged property. Simultaneously, you're quarterbacking the single most important document in this entire phase, the closing disclosure, or the CD. This is the official 5-page document that breaks down the final, exact numbers for the loan. Every single penny is itemized. The loan amount, the interest rate, the closing costs, the prepaid taxes, the homeowner's insurance, the credits from the seller, the cash needed from the buyer to close. And it has to be perfect. Not close. Perfect. By federal law, the borrower must receive and acknowledge this document at least 3 full business days before they can sign the final loan papers. This is known as the TRID 3-day rule. Here's where it gets terrifying. If you have to make a significant change to that closing disclosure within that 3-day window, like if the annual percentage rate, the APR, changes by more than a tiny fraction, or if the loan product itself changes, that 3-day clock resets. The closing is delayed. Imagine telling a buyer who has a moving truck packed and waiting outside their new house that they can't move in for another 3 days because someone fat-fingered a number. The chain reaction is catastrophic. Their rate lock might expire, costing them thousands. The seller might have their own moving truck packed, and if they can't close, they might not be able to buy their next house and that deal falls apart and so on. As the MLO, you are the final line of defense. You are checking the title company's fees, the attorney's fees, the real estate tax prorations, every single line item, comparing it against your own estimates, hunting for errors before that CD ever goes out the door. You are the guardian of that 3-day window. While you're playing financial detective with the CD, you're also a master scheduler. You have to coordinate the closing time and location with the buyer, the seller, both real estate agents, and the title company or closing attorney. That's 5 or 6 different parties, all with their own chaotic schedules. The seller's agent only does closings on Tuesdays. The buyer can only get off work after 4 p.m. The title company is booked solid. It's a logistical nightmare, and you're the one making the dozens of calls and emails to find that one sliver of time in the universe where everyone can meet. But let's say you do it. The walkthrough is fine. The CD is perfect. The closing is scheduled. You're in the clear, right? Not even close. Welcome to the world of prior to funding conditions, or PTFs. Just because the underwriter gave a clear to close doesn't mean the money is on its way. The file now goes to the funding department, a separate team whose entire job is to do one last check of everything before they wire hundreds of thousands of dollars. And they can and will add last-minute conditions. The most common and most dreaded PTF is the last-minute verification of employment. The funder will call the borrower's employer, sometimes just an hour before closing, to make sure they still work there. What if the HR manager is out to lunch? What if the borrower works for a huge corporation and the funder gets stuck in an automated phone tree? I've seen closings delayed for hours, with everyone sitting at a table staring at each other, because the funder couldn't get a live human on the phone to say, "Yes, John still works here." Or worse, what if the borrower got laid off yesterday and didn't tell you? The deal is dead. Instantly. You, the MLO, are frantically calling every number you have for the company, trying to find anyone who can provide that verification so the funder will release the wire. And then there's the closing table itself. Whether you attend in person or are on standby via phone, this is the final boss battle. The buyer looks at the final settlement statement and says, "Wait, what's this $100 fee? I don't remember this." Everything stops. All eyes turn to you. You have to be able to pull up your documents in seconds, explain exactly what that fee is, why it's there, and show them where it was disclosed to them weeks ago. You need the knowledge and the confidence to diffuse that tension immediately. Or maybe the amount for the cashier's check is wrong. The buyer brought a check for $52,500, but the final number is $52,650. They're short. It's panic time. The bank is about to close. You're on the phone with the title agent confirming the new number, while simultaneously talking your borrower through how to initiate an emergency wire transfer from their phone, guiding them through their banking app while the seller is tapping their fingers on the table. This is the job. It's not just taking an application and running credit. It's being a project manager, a crisis counselor, a logistics expert, and a financial wizard all at once. Your job is to absorb all of this stress so your client doesn't have to. They see a smooth, professional process. They don't see the 10 fires you put out in the last 24 hours to make it happen. They just know that you got them to the table, you got them the keys, and you made their dream come true. When that funding number finally arrives, and the title company confirms the wire has been received, there is a collective sigh of relief in the room that is unlike anything else. The papers are signed. The keys are exchanged. There are handshakes, hugs, and sometimes even tears of joy. For that one moment, all the stress, all the late nights, all the chaos, it all becomes worth it. You didn't just close a loan. You fundamentally change someone's life. And as they walk out of that office, keys in hand, you know the job still isn't quite over. You have to make sure that loan is sold on the secondary market correctly, that their first payment is set up properly, and most importantly, you have to begin the process of turning that happy client into a lifelong relationship and a source of future referrals. Because a single transaction is just a commission, a relationship is a career. And that's the fundamental shift in mindset you have to make. You're not just closing loans, you're building a business. A real sustainable long-term business. And the foundation of that business isn't built on rate sheets or ad clicks. It's built on relationships. Let's talk about what that actually looks like, because this is the part of the job that separates the people who make a decent living from the ones who build an absolute empire. Your number one source of business, especially in the beginning, will be other professionals who serve the same client base. The most obvious, of course, is the real estate agent. You need to think of yourself as one half of a partnership. The agent finds the house, you find the money. When that partnership works seamlessly, it creates an incredible experience for the buyer. And when you make an agent's life easier, when you are the loan originator who communicates proactively, who solves problems before they even become problems, who closes on time every single time, you become their go-to. You become an indispensable part of their business. But how do you build these relationships? You don't just send a friend request on Facebook and hope for the best. You have to provide value consistently and without expecting anything in return at first. Offer to co-host an open house and pre-approve buyers on the spot. Create a simple one-page guide on the top 5 mortgage questions your buyers will ask, and brand it with both of your logos. Take them to lunch and don't talk about yourself. Ask about their goals, their frustrations, and their ideal client. Listen. Become a resource. When an agent knows you're not just a loan taker but a strategic partner dedicated to their success, they will send you every client they can. But don't stop with real estate agents. Who else is a trusted advisor to someone about to make a huge financial decision? Financial planners, certified public accountants or CPAs, insurance agents, divorce attorneys. These are all professionals who have deep, trust-based relationships with their clients. When their client mentions wanting to buy a home or needing to refinance during a life change, who do you want them to think of? You. Building these relationships takes time. It's a slow burn. It's a lot of coffee meetings. It's sending them articles you think their clients might find interesting. It's creating a referral network where everyone is helping everyone else grow. You're not just a lone wolf. You're the hub of a financial dream team for your clients. This referral-based business is the bedrock of a stable career. It's what gets you through the lean months when the market is slow. But to truly scale, to get to that next level, you have to move beyond a one-to-one referral model and start building a one-to-many brand. This is where you stop being just a loan officer and start becoming a media company. Think about it. The number one thing that holds people back from buying a home is fear. Fear of the unknown, fear of the process, fear of making a mistake. Your job as a modern loan originator is to eliminate that fear through education. You need to become the most trusted voice on homeownership in your community. And today, the tools to do that are literally in your pocket. Your social media profile shouldn't just be a digital business card with your NMLS number on it. It should be a library of value. Stop posting "rates are low, call me," and start posting short, 60-second videos answering the questions you get every single day. What's the difference between a pre-qualification and a pre-approval? 3 ways to boost your credit score before you buy. Can I use gift funds for a down payment? When you consistently put out helpful, easy-to-understand content, a magical thing starts to happen. People you've never met start to see you as the expert. They start to trust you before they've even spoken to you. Realtors see your content and think, wow, this person really knows their stuff. They'd be great for my clients. You're no longer just hunting for business, you're attracting it. You become a magnet for your ideal clients. This branding effort then allows you to take the ultimate step in building a fortress of a business. Developing a niche. In the beginning, you'll take any loan you can get. FHA, conventional, a jumbo loan from your uncle's friend. You're just trying to get deals done. But as you grow, you'll realize that trying to be the expert on everything makes you the master of nothing. The most successful, highest-earning MLOs are specialists. They pick a lane and they dominate it. Maybe you're a veteran yourself, or you just have a passion for serving those who served. You can become the go-to VA loan expert in your state. You learn the guidelines inside and out. You understand the specific challenges and advantages for military families. Every piece of content you create is tailored to them. Every realtor who works with military clients knows that you are the only person to call. That's a niche. Or maybe you love working with doctors and residents. Their financial situation is unique. They have high earning potential but also massive student loan debt. You can specialize in physician loans, which have special guidelines just for them. You build relationships with hospitals and medical schools. You become the doctor's mortgage doctor. That's a niche. What about self-employed borrowers? The freelancer, the small business owner, the gig economy worker. They are notoriously difficult to get a mortgage for using traditional guidelines. But if you become an expert in bank statement loans and other non-traditional programs, you become a hero to an entire, underserved community. That's a powerful niche. First-time homebuyers, real estate investors, clients needing renovation financing, reverse mortgages for seniors, the possibilities are endless. The key is to find a group of people you're passionate about serving and then go all in. Your marketing becomes 10 times easier because you know exactly who you're talking to. Your referral partnerships become stronger because you bring a unique, specialized value that other loan officers can't match. You stop competing on price because you're no longer a commodity. You're a specialist, a solution to a very specific problem. And specialists command a premium. To manage all of this, the client follow-up, the referral partner outreach, the content creation, you have to leverage technology. A good customer relationship management system, or CRM, is not optional. It's the central nervous system of your business. It's what reminds you to call a past client on their home anniversary, to send a birthday card to a key real estate agent, and to track where your leads are coming from. It automates the mundane so you can focus on the meaningful, building those relationships. This is the long game. This is the stuff they don't teach you in your licensing class. The day-to-day work is processing files and putting out fires. But the career-building work, the work that creates true freedom and wealth in this industry, is building your network, building your brand, and building your niche. It's the difference between constantly chasing the next commission check and building a predictable, scalable business that generates opportunities for you, even while you sleep. It's the transformation from being a mortgage loan originator to being the CEO of your own enterprise. And that right there, that's the final evolution. It's the moment the ceiling on your potential shatters completely. Because being the CEO of your own mortgage enterprise isn't about having a fancy title. It's about a fundamental shift in your thinking. You stop hunting for deals and start building a machine that brings deals to you. Your brand, your reputation, your systems, they become your employees working for you 24/7. You're no longer just a participant in the real estate market. You're a pillar. People don't just come to you for a loan. They come to you for your wisdom, your network, and your certainty in a world of financial chaos. This is the long game. The career we've been mapping out, from the first day of studying for the SAFE exam to your 100th closing, isn't a sprint. It's a marathon of building trust, one client, one realtor, one handshake at a time. Anyone can close a deal. Anyone can learn the guidelines and run the numbers. But very few can build a legacy. Very few can build a business that becomes so synonymous with integrity and results that their name is the first one that comes to mind when someone whispers the word home. Think about that. What do you want your name to mean in your community 5, 10, 20 years from now? Do you want to be the person who was always available, always had the answer, and always fought for their clients like they were family? Or do you want to be the person who just did loans? The choice begins now with the habits you form and the reputation you start building from your very first call. Every email you send, every piece of advice you give, is a brick in the foundation of that legacy. Because let's be brutally honest, the paperwork is boring. The compliance is tedious. The stress of a deal falling apart at the last minute can be excruciating. If your only motivation is the commission check, you will burn out. I guarantee it. You will be chewed up and spit out by the sheer emotional volatility of this industry. You have to have a why that's bigger than the money. I want you to picture this. It's a Friday afternoon. You're at a closing table. Across from you is a young couple. They're maybe in their late 20s. You can see the exhaustion and the excitement warring in their eyes. For the last 45 days, you've been their guide, their therapist, their financial strategist. You walked them through fixing a credit issue they didn't even know they had. You explained debt-to-income ratios to them for the 10th time at 9 p.m. on a Tuesday, and you did it with a smile. You fought with an underwriter over a condition that made no sense, and you won. You've seen their bank statements, their pay stubs, their hopes and fears quantified on a balance sheet. You know their story. And now they're signing the final document. The attorney slides a set of keys across the table. The woman picks them up, her hand trembling slightly, and she just starts to cry. Not loud sobbing cries but silent, happy tears rolling down her cheeks. Her partner puts his arm around her, looks at you and mouths the words, "Thank you." In that moment, you didn't just originate a loan. You didn't just earn a commission. You fundamentally changed the trajectory of their lives. You gave them a home, a place where they'll bring their first child home from the hospital, a backyard where they'll host barbecues, a wall where they'll mark their kids' height as they grow. You became a pivotal character in their life story. That feeling, no amount of money can buy that. That is the fuel that will get you through the 14-hour days, the market downturns, and the soul-crushing disappointments. That is the real paycheck. Now, I know what some of you are thinking. This all sounds great, but can I actually do it? Am I good enough at sales? Am I smart enough for the numbers? What if I fail? Let me be clear. The fear is real. The learning curve is steep. And yes, you might fail. Your first deal might fall apart. You might have months where you make $0. You will face rejection daily. Realtors will ignore your calls. Clients will ghost you. That's not a possibility. It's a certainty. But the question isn't whether you'll get knocked down. The question is whether you have the resilience to get back up, dust yourself off, and make the next call. This career doesn't reward talent as much as it rewards tenacity. It doesn't reward genius as much as it rewards grit. The top producers I know aren't all charismatic, silver-tongued salespeople. Some are introverts. Some are analytical nerds. But the one thing they all have in common is an obsessive, relentless, borderline psychotic work ethic and an unwavering belief in their ability to find a way to win for their clients. They treat their mind like their most valuable asset. They are constantly learning, reading, and adapting. While others are complaining about new regulations, they're mastering them. While others are panicking about rising interest rates, they're creating strategies to help their clients navigate them. They don't see problems. They see puzzles waiting to be solved. They don't have a job, they have a craft. They are professional problem solvers who just happen to get paid through mortgage commissions. This is the mindset you have to adopt. It's a commitment to being a student for life. The mortgage industry of today looks nothing like it did 20 years ago, and the industry in 10 years will be completely different from today. Technology, artificial intelligence, and shifting economic landscapes will constantly change the rules of the game. You can either be a victim of that change or a master of it. The MLOs who thrive will be the ones who embrace technology to create a more efficient and human-centric experience. They'll use AI to streamline the mundane tasks so they can spend more time on what truly matters, building relationships and providing irreplaceable human advice. The core of this job, trust, guidance, and expertise, can never be automated. Your value is not in filling out a form. It's in the wisdom you provide while the form is being filled out. So we've come to the end of this journey together. We've pulled back the curtain on what it truly means to be a mortgage loan originator. It's a career of immense highs and challenging lows. It's a path that demands everything from you: your time, your intellect, your emotional energy. It is, without a doubt, one of the most challenging sales careers on the planet. But it is also one of the most rewarding. It offers a life of autonomy, of unlimited income potential, and of profound purpose. It gives you a chance to build a real business, to be the master of your own destiny, and to make a tangible, lasting impact on the lives of others. The information has been given. The path has been illuminated. The challenges and the triumphs have been laid bare. The only question that remains is the one that only you can answer. The question is no longer, what does a mortgage loan originator do? The question is, what will you do?